All right, I'm recording. Thank you, Lauren. Um, yeah, all right. So a little bit about my background. I've been in the industry since 2012. Before this, I had a customer service background. I was a restaurant manager for eons. And that's kind of how I approach things in the mortgage industry, with how I deal with my realtor clients and with how I deal with my actual clients who are buying a house. For me, it allows me to give a level of service that I believe is second to none. If we haven't worked together, I hope we get a chance. You'll get to experience that. I did recently make a switch to Garden State Home Loans just a couple months ago, right before everything kind of fell apart. So always a great time to make a switch. I made that change because they just have really great systems that are available. We have a native app that connects all of our realtors so that you can go in and do mortgage calculations. Your clients can do mortgage calculations. You can create your own pre-approval letter so you don't have to hound me if it's Saturday at 10 p.m. and you need a new letter. So just really like their systems and programs. And they also generally have some of the best rates that are in the industry. Generally with my clients, when I was at my last firm, if I was losing a deal, it was only to one or two places, and usually it was to Garden State. So that was another big reason I made the move over here. Things are definitely interesting. It was definitely an odd time to make a career jump at the beginning of March, right before everything changed. But all in all, it's going really well. And I'm really happy that I made the switch. Some things to know about the industry in general right now. Keep in mind, no two lenders are exactly the same. So the things I'm going to talk to you about today do apply to me, and in general are going to apply to some and most lenders, but not everyone. There are always exceptions to rules, and it's just a matter of being able to find a lender that can help you, especially if you've got clients that are in really unique situations. The easiest example of this is FHA loans. Everyone thinks that they've got these credit score requirements. FHA itself doesn't actually set any credit score requirements. It's up to the lender what that credit score requirements are going to be. So in early April, when you heard about FHA changing credit score requirements to 640 or a 680, that wasn't actually FHA itself. That was all of the larger lenders in the industry made that decision. And so then all of the smaller lenders and brokers have to adjust their rules to meet those requirements. And the reason the smaller lenders adjust their rules to meet the larger lenders' requirements is because for the most part, all loans are bought and sold on a secondary market. And so if a small lender doesn't have the capital to be able to keep a client's loan in-house, they need to be able to sell it off to a Bank of America or Wells Fargo or Chase. So anytime those large banks change their requirements, like the credit score requirement that they changed, those smaller lenders are going to follow suit because they've got to be able to have the option of selling their loans and the servicing of the loans to these other lenders. And the only way you can do that is if you're matching their requirements. So if you had a deal that kind of went a little sideways because of some of these changes, or is in the process of might be going sideways, don't necessarily give up hope that that deal is dead. You might just have to talk to some other lenders to see what your options are. Right now, I still have one of our investors that allows for a sub 640 FICO score on FHA loans. So it's allowing me to get some deals done that other lenders are not right now. I'm saving 2 from PNC and 3 from Weichert Financial because they all had to follow suit with everyone else with the credit score requirements, but I'm able to still do a sub 640 FHA loan or VA loan. So I'm able to keep some deals moving for some realtors who thought that the loan might be falling apart for the purchase. If you had a client who was actively shopping and was pre-qualified before the first week of April, you're going to want to have them check and get pre-approved, because that's really when all of these changes went into effect, and you want to make sure that they're not shopping with a pre-approval that's incorrect. Right now, for the lending industry overall, I'm just going to ask that you be patient and be flexible. Timelines are not normal, especially when you've got a unique client that can only go to one specific lender, like my sub 640 FHA lender. That's the only place I can send them. So I'm on their timeline and they're inundated with business because they're the only people that are out there doing these loans right now. You've got to be flexible, have a little bit of wiggle room with dates, give a little bit longer on the mortgage commitment date if you can when you're writing the contract. Make your clients be prepared to have a B plan. So if they can, if the situation that they're in allows them to not immediately have to move the day of settlement or the day after, have them build in a buffer for when they schedule the movers. Having B plan set up during this time is going to be really important because everything's changing constantly. The biggest change for the industry and what's causing timelines to shift and move is that verification of employment has become everything. As so many people have lost their jobs or their job statuses have changed, the verification of employment rules have changed for the entire lending industry. All we used to have to do is that we do a written verification of employment that we would get from their employer verifying their income information. And then within 10 days of settlement, we just do a quick phone call confirming, yes, they still work there. That was all that we used to have to do for verification of employment. The rules are now very different for that. I'm going to go into the details in a second. With the employment piece, if someone has been furloughed because of COVID-19, they're going to have to put things on hold. They have to return to work before they're going to get an approval from an underwriter. Similarly, if their employer is allowing them to use paid time off, but they've stopped working, paid time off does not work. They've got to show that they are back to work, because we don't know that they might run out of PTO before this thing ends, since the timeline is unknown. If their pay stubs mention a leave of absence or any kind of COVID pay, the underwriter is going to assume that they're not working their normal hours. And again, proof that they have returned to work is going to be required. The employee must be fully employed and working as normal. If their hours are just reduced, if they're an hourly employee, that's fine. We're just going to use whatever their new reduced hours are, but that income is still fine. The new procedures for how we now verify employment. We're still going to do that formal written verification of employment that we get directly from the employer, but we're also going to need a signed letter by the buyer saying that they are still employed, that their income has not changed, and that COVID-19 is likely to not change their employment status or income status. We have to get a direct supervisor or HR contact that can respond to verification of employment same day. Most clients, we also require an additional written letter from that direct supervisor saying that they are still employed. So it's two forms of written information from the employer, one from the borrower. And the other reason we need that direct contact information is within 3 days of settlement, someone's going to reach out to that supervisor to verify they're still employed. And then the day of settlement, first thing in the morning, they're going to do a final verification to confirm that the person is still employed. And so that if the direct supervisor or HR contact cannot respond instantaneously, settlement will get pushed or delayed. So it's making it really tough. And that's why you'll hear like settlements are no longer a half hour, 45 minutes, they're an hour, 2 hours, because the lending industry isn't releasing docs or wires until they've gotten that response from the direct supervisor or HR contact. So it's all those extra verification of employment steps that they put into place that is making timelines move a little slower and making things a little tougher for the mortgage industry. So that's where your patience and flexibility helps. And we are fleshing all this out for the buyers. They know this once they go under contract. They know what we need from them, but it just makes things a little bit unique. If someone is self-employed, we're going to need some kind of recent invoice or recent receipt that shows that they are still working. If the business that they run has a physical location, we're going to need to show that that business is still open and operating. So if a self-employed borrower owns a tanning salon, we know that that's going to be closed right now, so they're not going to be able to get qualified until everything has been reopened. So it's definitely a little tougher for self-employed people right now, unless they can provide some kind of written invoice or receipt to show that they are still actively working. All right, so with that, I'm going to move on to some COVID-19 rule changes from our main investor. So our main investor is the person that is the main lending institution that buys probably 90 to 95% of our loans after they're done and funded. So these are these are the rules that have changed that most of our clients are now obligated to follow. There are some exceptions, and I will go into those later. So again, like I said at the beginning of this, these are rules that are specific to me. However, a lot of other lenders are under very similar rules, but don't just assume that this rule applies for everyone. So again, if you've got a client where a deal went a little sideways or it looks like it's falling apart or has recently fallen apart, it doesn't mean another lender can't get it done, but they're going to have to do a lot of research to see if they can find someone that can. All right. So credit reports. So these are the changes. Bear with me. I'm going to look a little bit away from the camera because I've got to look at this list. The credit reports have to be dated within 30 days. We used to be able to use ones that were 90 days old. That's not the case anymore. So credit pulls are happening a lot more frequently for buyers. If they've got a credit score that is under 680, their debt to income ratio has been capped at 40%. It is a hard line. There is no options around that, again, for our main investor. If their FICO is above 680, they can go above that 40% debt to income ratio as long as they have 3 months reserves. So the reserve is, one reserve is a 1 month's mortgage payment. So that's principal, interest, tax, and insurance. So if the total housing payment is $1,500, 3 months reserve is going to be $4,500. So a lot of clients have to have additional assets or retirement funds that they're going to need to get the approval at this time. If they have an American Express that is the standard Amex where it has to be paid in full every month, we used to be able to just write that off and not count it as long as they had enough savings to show that they can pay the balance. There's now a 5% monthly payment that's calculated into that. All reserve requirements. So they've added some other additional reserve requirements. If the client is a first-time home buyer, we have to be able to show that they've got a verification of rent. So they need to have been renting for the past year. If they have not been renting for the past year and they're currently like living at home or living with a family or a friend, and they can't give us a verification of rent, 3 months reserves is now needed. And the reserve requirements for any of the future that I talk about are all stacking. So if they needed 3 months because they're over that 40% DTI, and they need 3 months because they're a first-time home buyer who doesn't have a rent verification, that's now 6 months that they need. So it's not one or the other. It continues to stack and build. They can use retirement assets for it. We just have to show that if needed, the retirement assets can be liquidated. All right. If they own additional properties or have rental income, 6 months of reserves is required for each additional property that they own. And if they're using rental income as part, so if they can't, so there's 6 months reserves for the house just being in their name. If they're also using rental income to qualify, meaning they cannot qualify without that income, there's an additional 6 months of reserves that they're going to need. So that's 12 months of reserves for someone that's owning rental and investment properties. For W-2 borrowers, the pay stub has to be within 30 days of the settlement date. So we're getting more pay stub updates than we normally used to have to do. They have to have that signed COVID-19 letter saying that their income is not affected. The borrower must be fully employed at times of closing, so they can't be on any kind of leave of absence, whether it's medical, maternity, paternity leave, or obviously anything related to COVID. They've got to be fully functioning and working. Again, we can use reduced salaries or reduced income if they're hourly and getting paid less, as long as they can still qualify with that reduced income. So if they're just working less, or if the company said, hey, we're going to keep you employed, but everyone's taking a 10% pay cut till this is over, that's fine. We can still use their income. It doesn't affect the approval. We just have to use whatever that reduced income is. Alimony and child support. It used to be that we only needed 3 months of receipt. They now have to have been receiving it for at least 6 months, and it has to show that it's going to continue for at least 3 years beyond the settlement date. All right, so this next session is about self-employed borrowers. So this is the tougher one. For most of them, they're gonna wanna have filed their 2019 taxes. Because the extended tax filing date went till July 15th, they don't technically have to qualify, but for most people, their most recent tax return shows their best income. So if they've made less money in 2018 than they did in 2019, they're not gonna wanna wait just because the IRS is giving them that option. They're still gonna wanna file. But it is not required since they extended the date. So we can use the 2017 and 2018 returns, but they're still going to use that 2-year average. So if they made more money in 2019, still push them to get their 2019 taxes filed. So because the IRS is shut down, we as a lending industry can't pull tax transcripts anymore. So the buyer has to now go in and pull their own. We will also need copies of any canceled checks to or from the IRS if they owed the IRS money or if they were getting a refund from the IRS. We have to show, that shows us that everything was processed and done with the most recent return. Self-employed people are automatically required to have 6 months of reserves, and their income is automatically reduced by 25%. So again, self-employed borrowers are in a bit of a tough spot right now. It's a little harder for them if it's a spouse or if it's a couple and both are self-employed. This is going to get really tough. If you've got one that's not self-employed, then it stays a little bit easier. Again, these rules have all gone into play because of COVID-19. And as things start to open back up and relax, these rules will all slowly go away, but we don't know when that will happen. So you just want to, again, have your people be as flexible as they can and be prepared that things are a little tougher. As the rules relax, we'll let everyone know. They will eventually go back to the normal that we've had all gotten used to. It's just going to be a matter of when. All right, so again, those were all of the rule changes for our primary investor. There are exceptions to that. Like I said, each investor sets their own rules. One of the perks for Garden State Home Loans is not only are we a direct lender where we're selling directly to Fannie Mae, Freddie Mac, the government agencies, we are also a broker. And that's what's giving us the options to be able to do some loans that the other companies are no longer able to. Is because if I can't use one of the big investors, I can broker the deal to these smaller banks and be able to get the loan closed. The process, we have less control because when we're brokering it, they do 100% of the file. So we're on their underwriting turn time. So if they're swamped and it's 7 days till an underwriter looks at it, we're stuck. We got to wait the 7 days till they look at it. So things are going to move a little bit slower with the broker options, but if it allows you to save a deal and just have to extend the contract and settlement date, it's better to get the deal closed than lose the deal altogether. Some examples around this are, again, how I can still do an FHA down to a 580 without a reserve requirement as long as the borrower is getting an approved eligible through the underwriting systems. I can still do conventional loans without the reserve requirement, but it's through this broker channel. So again, times are a little slower, but there are those options. So I realize I just gave you a lot of rules, and I'm now saying that those rules don't always apply. When we can, we want to work with the bigger investors because it allows us to underwrite in-house. It allows us to close in 30 to 40 days like it's a normal purchase, like everything's operating as normal. So for your top tier clients, that's the channel that we're going to go down. We're going to stick to that so we can keep everything moving and quick and going as smoothly as possible for everyone involved, because that's what it's about. It's about making sure that you're getting paid, they're getting to the house that they need, and everyone's happy. But for your unique clients or your lower credit profile clients, they still have options. They've just got to be flexible and patient. Things to keep in mind, things are always changing. These initial changes to the rules were a gut punch reaction for the industry to make sure that they could stay solvent and liquid as, money started to run low for the entire industry. The rules will continue to change. So someone could get pre-qualified right now, and in a week, the rules could change and their pre-approval could fall apart. You want to have your people checking in a little bit more frequently with their lender than what they used to do. If their lender is doing their job right, they should be checking in with the client anytime any of these rules change and it applies to them, but not everyone pays as quick attention as they should be. Rates and markets are still highly volatile. So any quote that clients are out there getting for a rate, it's going to be good for that next hour. Over the past couple of weeks, I have seen a 0.5% jump in rates 3 different times. So within 2 hours, I've seen a rate go from 3.5 to 4 within a 2-hour window of time. So rates are still all over the place as the markets adjust to everything that's going on with the unemployment rules and everything. So if your clients are shopping for a lender right now, they can shop for whoever's got the lowest rate right now, and then it would probably be easiest for them to then, once they've selected that lender, to stick with it. If they keep trying to reshop and reshop, they're going to just burn themselves out and exhaust them because things are changing so constantly. They've got to shop for that specific moment and assume that everyone's rates are kind of moving together. So if that lender was the lowest at that time, they're probably going to be the lowest overall because they could shop them. The buyer really could shop themselves to death right now because things are so volatile and changing constantly. Or, if you want to make sure that the lender can get everything done. So if they found a lender that they trust, that you can get the job done, Right now, that might be a little bit more important than are they getting the absolute most perfect best rate? Because not all lenders are getting everything done right now, or turn times are really slow or dragging really long, where you're no longer hearing from your lenders not being responsive because of everything going on. You want to make sure you've got someone who can get you to the finish line and get these deals done for you. All right, so that was all I had to go over. So if you've been jotting down questions, put them in the chat for me so I can go through and ask them. So far, I've only got one. I was expecting more. And use if you've got specific buyer scenarios, ask that, because I promise you, if you've got a buyer in that situation, someone else probably does as well. So even if it's just, you think it's specific to you or a client you have, it's still going to be a good question to ask, because things are just so unique right now. All right, Stephanie. So there is definitely a softening when it comes to the gaps of employment right now, because the lending industry understands that all of a sudden a lot of people have gotten laid off, or they might just be temporarily laid off. So there's going to be a little bit of an area where they are forgiving with that gap in employment because of this time. There's no official rule or guideline around it, but it is known and understood in the industry that that's going to happen. You could have had someone there's a lot of restaurants and bars that are laying people off, knowing that in 60 days they're going to rehire that exact same staff. So they're going to have a gap in employment. For the most part, that's going to get ignored. So yeah, so if someone loses their job and finds another one, as long as the income piece stays similar or is the same from job to job, that's the part that's going to matter more. So did they leave a W-2 salaried position and get hired at a W-2 salaried position? And that's the same as it would have been at any other point in time. As long as the income piece stays fairly consistent, that's going to be more important than the gap, because there's going to be a lot of people that are going to have a gap right now because of everything that's going on with this. Thanks, Gavin. Appreciate that. I would default for, all right, so Dan asked, what's the recommended lead time for an agreement of sale to closing? Right now, I would say, just to be safe, go for 45 days. Again, there's still times where 30 to 35, the old standard, is definitely doable, especially if you've got a top tier client. So if it's a client that's doing, that's a clean, conventional client, newer construction house where we're not really worried about appraisal repairs, and they've got a 760 or higher credit score. If you want to do a 30 to 35 day contract, we're going to be able to get that through and done. That's not going to be a problem. And that's specific to me. Again, that might not be specific to every lender. I know a lot of the big banks are still funding deals as normal, but their turn times are a lot slower just because they're inundated with business. So to be safe, if you want to reduce the chances of an extension, I would just default to a 45 day right now and move the mortgage commitment to a 30 day for the mortgage commitment, because that just gives the extra lead time up front for us to do all the verification pieces that we need. One of our investors right now is no longer approving files until they have the appraisal. They used to do the approvals before the appraisal got received. Now they won't do it until they have the appraisal. So there's just little nuanced details. So I would extend the commitment time frame more. And that should overall cover you. How much do I trust Credit Karma? 0%. So the reason for that, and that's not Credit Karma's fault. So Credit Karma is not allowed to do a hard inquiry on people's credit. It's the nature of their industry. And they're not the only one that's in that game. But because it's not a hard inquiry, they aren't getting the full credit picture. So it's always an inaccurate score because they're missing pieces of information. So it's not their fault. What my recommendation is with clients with Credit Karma. Credit Karma is good to judge how your credit scores are moving. So if you're looking at your score and one day it's a 650 and the next day it's jumped up to a 675, so it's made a 25-point jump, for me, it's probably moved about 20 points. So it's, again, making a very similar move. So you go, all right, it went up. That means my scores went up. That's going to be fairly accurate. But the actual number is usually not going to be accurate. Credit Karma is going to be off anywhere from 20 to 50 points, and there's no way to know what that is without pulling the inquiry. The other thing to keep in mind, credit scores vary from industry to industry. If I run someone's credit report today and then they go to a car dealership, if they were open, and they ran their credit report, they're going to get a different credit score number because different industries have different models. The mortgage industry, because of what the what is being borrowed against is the most accurate and true credit score. If your clients want to have a really good idea of what their credit scores are with it being accurate, the best way is through the credit card companies. So a lot of credit card companies, Discover, Capital One, have that option where you can turn on FICO tracking and it shows you what your FICO score is on your monthly statement. That's usually pretty accurate and within a couple points of what I'm gonna see. So if they have a credit card that gives that as an option for them, that's gonna be their best way to go, not Credit Karma. Other thoughts, questions? Sit here in awkward silence.
Adam, I have a question.
Yeah.
I have seen, and I apologize, you might have mentioned it and I might have been on the phone, but I've seen a lot of chatter about lenders being really backed up in terms of like delays in appraisals or, getting pushed settlement dates and things. So I know you covered that new contracts should be, look at least a 45-day closing, but what are your thoughts on current pendings and have you seen a lot of delays?
I haven't seen, well, so that's really going to vary from lender to lender. You are correct. In general, the entire industry was inundated with business, and partially some of that is because right before everything that happened with COVID-19, you had a huge drop in interest rates. So there was this massive boom in refinances, and that backed up the industry and slowed things down and drive the interest rates a little bit higher. And then everything happened with COVID-19. So you had a bunch of people rushing to try and get in before things got real bad. And then the industry was just trying to deal with changes and having to redo files that were approved and were no longer able to get approved. Personally, I have not had too much by way of delays of actual scheduled settlements. But it's something you're just going to want to talk to your lender. Things are moving slower in general. Like I had for one of our broker deals, they went under contract. I got their file disclosed, submitted. They were in line to get reviewed for an underwriter, and then the FHA credit scores happened. And my client was at a 636, so they were under that 640 threshold. I had to completely kill the file, create a new file, redisclose it, resubmit it to this new lender who was bogged down now because they're the only ones doing these loans. And it took over 7 days to get the approval. So we were almost 3 full weeks into the contract before an underwriter even looked at the file. The approval came really, really late, like the day before the commitment date. So things are definitely backed up, and anytime you've got the special requirements with it, if they want the appraisal ahead of time, or if they need the verifications to be done ahead of time, it's going to bog things down and slow it down. So for your current deals that are in process, it's just going to depend upon where they were in the process when all of this happened. So there's not really a way to say. You're going to have to look at it on a case-by-case basis and talk with the lender. If the lender hasn't reached out to you, I generally advise that no news is good news if they've still been in communication. If they've gone radio silent, that's bad. But if you've been hearing from them and they haven't told you anything, then that likely means on their end, everything for that file is probably still flowing fine and they don't have any concern. Because generally we're not reaching out unless we have a concern.
Thank you.
Yeah, so Brandon, yeah, that was the employment piece that I talked about at the beginning. So employment verifications will always happen on the day of settlement. That is the new normal for the entire industry. So it's not that they're happening late, it's now that they're happening like 5 times. And the last one is on the day of settlement. So all that can be done is that the client needs to make sure that they're providing the lender with not just like the general HR contact phone number, but a specific person's contact information, and that the client has talked to that person and said, hey, I'm buying a house. I need to give them someone's contact information who's able to answer essentially instantaneously when they receive requests. Is that something you can help with? So the client's gonna have to do that. And we prep the client and we tell them this, like when I'm asking for this information, I say that in the request. I'm like, this person is going to have to be able to answer same day instantaneously. And that's because of that settlement day verification that's now required. It goes out usually for most lenders somewhere between 8 and 9:30 first thing in the morning for all settlements that are happening that day. So the HR manager who's answering an email, as soon as it comes in, that loan's probably going to close and fund, and settlement's not going to be more than an hour. For ones where it takes 2 to 3 hours for that person to get back, settlement's going to take 2 to 3 hours, because again, the lenders are not going to send out wires or docs to the title company until they have that verification in. And that's purely just because the unemployment rate is so high right now, and we want to make sure that people aren't losing their jobs. One of my coworkers had a deal die 3 p.m. the day before settlement, because 2 p.m. the day before settlement, the client lost his job. There's just no way that people don't see this coming, so there's no way for the industry to prepare for it other than do these really annoying verifications. But they exist just because of where the industry is at right now. Correct, Elena. Yeah. So again, it's the reserve requirements is going to vary from lender to lender, but for right now, that is the requirement for our main investors. That if someone has been living with family and we cannot show that they have a history of rent, they're going to need 3 months reserves. They're going to need additional assets left over when the transaction's said and done. Again, there are exceptions to that. So if they absolutely don't have it, we're going to push them over to a broker channel. Again, I'm speaking for myself specifically, not the industry as a whole. So we'll need flexibility on timelines because of it's a broker channel. So yeah, but in general, if a client has that, it's just going to make things easier for them if they've got money left over. And the money doesn't have to be money that they have now. They can get a gift, just like you could always get a gift. The gift can count towards the reserves. So if they've got a family member that can give, so if they've got a family member that can give them the money as the gift as part of this process to just put in their savings account to save, that counts. If they've got a retirement fund, as long as we can show that it's a vested balance and that they can liquidate it if need be. Even if there's a penalty or tax on it, that doesn't matter. As long as we can show that it can be liquidated, that counts as a reserve requirement. So those two items make it a little easier. It doesn't have to be money that they have directly. Stephanie, I'm going to unmute you. Do you mean first-time homebuyer programs like grants? What do you mean first-time homebuyer programs?
Like to assist with closing costs during this time?
There's nothing special that's come out at this time that's specific to this. There is always the state program through New Jersey, and Pennsylvania has one as well. They're not grants, they are loans that are paid back to the state. So those programs still exist, but there's nothing specific that exists to help clients right now related to these changes. It's just the standard items. So, and keep in mind for things like the Philly First Home Grant, as Gavin can testify right now. So anything that, any piece of a loan that has contact with an outside industry that is currently shut down or is only semi-working, it makes things a little tougher. So I've got a client that's going through the Philly First Home Grant right now, and we think we're going to close on time, but it's a little unknown because the city of Philadelphia shut down. So we're waiting to see, do we get the approval letter from the city in time to get it to underwriting, to get it reviewed, to close on time. So anytime you have an interaction like that, or if you've got special inspections where you need an engineer to get out, if you can't get the engineer out, that's why you want to have a B plan for your client. If something comes up, again, if it's a really well-built house, new construction, or just really well maintained, and it's an 800 credit score client, they're probably going to be fine for 35 days. But you want to always have this B plan, because if there's appraisal repairs and you can't get someone to come out and repair the item, you're now stuck delaying and extending settlement. So always having a B plan for your clients until things start to relax and go back to normal is going to be key right now. I'm going to do a final call for questions, comments, thoughts, concerns, you can put it in the chat box or unmute yourself, whatever's easiest. Again, I will type everything up in a frequently asked questions form and send that out to everyone once I have my marketing person make it pretty. All right, well, with that, I'm going to put my contact information in the chat one more time. So if you come up with a question after the fact, just reach out to me. But I appreciate you coming out and joining my call. I hope you all have a great week. Stay safe. And if you ever need anything, I am always here to help. All right.
Thank you, Adam.
Thanks all.
Thanks, Adam.
Thank you, Adam.